The stock market can feel confusing, not because it is impossible to understand, but because it has its own language. Stocks, dividends, indexes, ETFs, bull markets, bear markets, PE ratios, volatility, inflation, interest rates. At first, these words sound random, but they are not random. They are all pieces of the same system. Once you organize them into a map, the stock market becomes much easier to understand. So, in this guide, we are not just going to define stock market terms one by one. We are going to connect them step by step, so you can understand how the market actually works. This video is for educational purposes only. That is not financial advice. Let's start with the first question. What are you actually buying when you buy a stock? Before you understand charts, prices, or market news, you need to understand what a stock actually is. A stock is not just a number moving on a screen. A stock represents ownership in a real business. When you buy a stock, you are buying a small piece of a company. If that company grows, earns more money, and becomes more valuable, your shares may become more valuable too. But if the company struggles, your investment can lose value. There are two main types of stock: common stock and preferred stock. Common stock is what most investors buy. It usually gives shareholders voting rights and a claim on company profits. But dividends are not guaranteed. A dividend is part of a company's profit paid directly to shareholders. Some companies pay dividends regularly, others do not. Instead, they reinvest profits to grow the business. Preferred stock works differently. Preferred shareholders usually have less voting power, but they often have priority when dividends are paid. Once you own more than one investment, you have a portfolio. A portfolio is the full collection of investments you own. It can include stocks, ETFs, mutual funds, bonds, cash, or other assets. Your portfolio matters because it shows where your money is exposed, but not every company is available to public investors. A public company has shares that ordinary investors can buy and sell on the stock market. A private company keeps ownership limited to founders, employees, or private investors. To measure how groups of stocks are performing, investors use indexes. An index is a basket of stocks designed to represent part of the market. Think of it like a scoreboard. The S&P 500 tracks 500 of the largest U.S. companies and is often used as a benchmark for the overall market. The Nasdaq is known for many technology and growth companies. The Russell 2000 tracks smaller U.S. companies. When investors say they want to beat the market, they usually mean they want to perform better than a benchmark like the S&P 500. That sounds simple, but it is very difficult, even for professionals. So the first idea is simple. A stock is ownership. A portfolio is your collection of investments. And an index is a way to measure the market. Now that you know what a stock is, the next question is, how does a stock actually get bought and sold? Stocks trade on a stock exchange. A stock exchange is the marketplace where buyers and sellers trade shares. One of the most famous examples is the New York Stock Exchange. But most individual investors do not trade directly on the exchange. They use a brokerage. A brokerage is a platform or service that connects investors to the market. When you use an investing app or online trading account, you are usually using a brokerage. Some brokerages may charge a commission. A commission is a fee for making a trade. Every stock also has a ticker symbol. A ticker symbol is the short code used to identify a stock. AAPL for Apple. TSLA for Tesla. During the trading day, every stock has a stock price. The stock price is the current price of one share. It changes based on what buyers are willing to pay and what sellers are willing to accept. The opening price is the first price of the regular trading session. The closing price is the final price when regular trading ends. Regular U.S. market hours are usually from 9:30 a.m. to 4 p.m. Eastern Time. But trading can also happen outside those hours. Pre-market trading happens before the market opens. After-hours trading happens after the market closes. These sessions often react to earnings reports, company news, or economic announcements. But there is a catch. They usually have lower volume and lower liquidity. Volume shows how many shares are being traded. High volume means more activity. Low volume means fewer shares are changing hands. Liquidity means how easy it is to buy or sell a stock without moving the price too much. Highly liquid stock is easier to enter and exit. Large companies like Apple or Microsoft are usually very liquid. Smaller stocks may be harder to trade smoothly. So trading is not just clicking buy or sell. It involves exchanges, brokerages, ticker symbols, market hours, stock prices, volume, and liquidity. Now you know how stocks are traded. But the bigger question is this. How do investors decide whether a stock is worth buying? A stock price alone does not tell you whether a company is good, bad, cheap, or expensive. A $20 stock is not automatically cheaper than a $200 stock. To understand a stock, investors look at the business behind it. The first concept is market capitalization, often called market cap. Market cap is the total market value of a company's shares. You calculate it by multiplying the stock price by the number of shares outstanding. Enterprise value goes one step further. It looks at the company's market value while also considering debt and cash. This gives investors a fuller picture of what the business may be worth. Then investors look at financial performance. Revenue is the total money a company brings in from sales. Net income is what remains after expenses are subtracted. In simple terms, net income is profit. This difference matters. A company can have huge revenue and still have weak profits if its costs are too high. Investors also study the balance sheet. Assets are what a company owns. Cash, property, equipment, inventory, liabilities are what a company owes. Loans, debt, unpaid bills. Other obligations. To compare companies. Investors use ratios. Earnings per share, or EPS, shows how much profit a company makes for each share of stock. The PE ratio, or price-to-earnings ratio, compares the stock price to earnings per share. It helps investors understand how much they are paying for each dollar of profit. A high PE ratio may mean investors expect strong growth, but it may also mean the stock is expensive. A low PE ratio may mean the stock is cheaper, but it can also mean investors see slower growth or higher risk. The PEG ratio adjusts the PE ratio for expected growth. Dividend yield shows how much a company pays in dividends compared to its stock price. Free cash flow is the cash left after a company pays for operations and investments. This cash can be used for dividends, buybacks, debt repayment, or future growth. Finally, investors look at margins. Gross margin shows what is left after the direct cost of making a product. Operating margin shows what is left after regular business expenses. Net profit margin shows what percentage of revenue becomes actual profit after all costs. So investors are not just asking what is the stock price. They are asking how big is the company, how much money does it make, how profitable is it, how much cash does it generate, how much debt does it have, and how expensive is the stock compared to the business. Once you understand how investors judge companies, you can understand the next idea. Not all stocks behave the same way. Some are built for growth. Some are known for stability. Some move with the economy. Others hold up better during hard times. A growth stock is a company expected to grow quickly. These companies often reinvest profits instead of paying large dividends. A value stock is different. A value stock looks cheap compared to its fundamentals. Investors buy value stocks because they believe the market may be underestimating the company. A blue chip stock is a large, well-established company with a strong reputation. These companies are often seen as more stable and reliable. Then there are cyclical stocks. A cyclical stock moves closely with the economy. When the economy is strong, cyclical companies may do well. When the economy slows, they may struggle. Cars, airlines, hotels, and luxury goods are common examples. A defensive stock is different. Defensive companies sell products or services people need in almost any economy. Food, utilities, healthcare. They may not always grow as fast, but they can be more stable during downturns. Stocks can also be grouped by size. A large cap company is usually worth more than $10 billion. A mid-cap company is usually worth between $2 billion and $10 billion. A small cap company is usually worth less than $2 billion. Small cap stocks may offer more growth potential, but they can also be more volatile. Then there are penny stocks. Penny stocks are very low-priced shares, often under $5. They can attract investors looking for big gains, but they are usually highly speculative and risky. So before buying a stock, investors should ask, what type of stock is this? Growth or value? Blue chip or speculative? Cyclical or defensive? Large cap, mid cap, small cap, or penny stock? Because the type of stock you buy affects the type of risk you take. But investing does not always mean picking individual stocks. There are many other ways to participate in the market. Many investors use funds and other assets to build broader exposure. A mutual fund pools money from many investors. Then it uses that money to buy a mix of stocks, bonds, or other assets. A professional manager usually chooses and adjusts the investments. An ETF, or exchange-traded fund, is similar in some ways, but it trades like a stock on an exchange. That means you can buy and sell ETFs during market hours. Many ETFs hold a basket of stocks, bonds, or other assets. An index fund is designed to track a market index, such as the S&P 500. Instead of trying to beat the market, an index fund tries to match it. That is why index funds are popular with long-term investors who want broad exposure and lower costs. Some funds are more advanced, like hedge funds. A hedge fund may use strategies such as leverage, short selling, or derivatives to pursue higher returns. Hedge funds are usually for wealthier or qualified investors, and they often carry higher risk. There are also tax-advantaged accounts, such as a Roth IRA. A Roth IRA is a retirement account where contributions are made with after-tax. Money that qualified withdrawals in retirement can generally be tax-free. Beyond stocks and funds, investors can also buy other asset classes. Bonds are basically loans. When you buy a bond, you are lending money to a company or government. In return, they promise to pay interest and eventually return the principal. Principal means the original amount of money invested, or loans. Commodities are raw materials. Gold. Oil. Natural gas. Wheat. Agricultural products. Currencies allow investors to trade money from different countries. Dollars. Euros. Yen. Pounds. Cryptocurrencies are digital assets that trade separately from traditional markets. Bitcoin and Ethereum are two of the most well-known examples. So the investing world is much bigger than individual stocks. You can invest through mutual funds, ETFs, index funds, hedge funds, retirement accounts, bonds, commodities, currencies, and cryptocurrencies. The question is not only, which stock should I buy? The better question is, which tools and assets fit my goals, risk tolerance, and time horizon? Once you know what you can invest in, the next question is, what kind of market are you investing in? Even if you understand a company, you still need to understand the market around it. Markets move through different conditions. Sometimes investors are optimistic. Sometimes they are fearful. Sometimes prices rise slowly. Sometimes they fall suddenly. Volatility measures how much prices move up and down. A highly volatile stock can swing sharply in both directions. A low volatility stock usually moves more steadily. Investors also watch the VIX. It is often called the fear index. The VIX measures expected volatility in the S&P 500 over the next 30 days. When the VIX is high, investors usually expect larger market swings. A bull market is a long period of rising prices and investor optimism. A bear market is the opposite. It is a long period of falling prices and investor pessimism. But not every decline is a bear market. A correction is usually a drop of about 10% from recent highs. A rally is a sharp rise in prices, often after a decline. A crash is more extreme. It is a sudden and severe drop in stock prices, often caused by panic, financial stress, or major events. Then there are market bubbles. A market bubble happens when prices rise far above reasonable value, usually because of hype, speculation, or excessive optimism. When a bubble bursts, prices can fall dramatically. Market sentiment describes how investors feel about the market overall. Are they confident, fearful, greedy, cautious, excited, nervous? Sentiment can strongly influence prices, sometimes even when company fundamentals have not changed much. That is why the market is not just numbers. It is also emotion, expectation, fear, optimism, and reaction. A good company can fall in a bad market. A weak company can rise during hype. Market conditions matter. Once you understand the market environment, the next question becomes personal. What is your investing strategy? Understanding the market is one thing. Deciding how to invest is another. Your strategy determines how you respond when prices rise, when prices fall. And when the market moves against you, passive investing is a long-term approach. Instead of trying to pick individual winners, passive investors often buy broad market funds. For example, an index fund or ETF that tracks the overall market. Then they hold it for many years. One common passive strategy is dollar cost averaging, or DC. DCA means investing a fixed amount regularly, no matter what the market is doing. When prices are high, that fixed amount buys fewer shares. When prices are low, it buys more shares. This can reduce the pressure of trying to choose the perfect time to invest. Lump sum investing is different. It means putting a large amount of money into the market all at once. It can work well if the market rises, but it can feel risky if prices drop soon after. Buy and hold means buying investments and keeping them for years. It lets time and compounding do their work. Active investing is the opposite of passive investing. Active investors try to outperform the market. They may pick individual stocks, time trades, or make specific investment decisions. Buy the dip means buying after a price drop, hoping the investment will recover. Market timing means trying to predict the best moments to enter or exit the market. This is very difficult, even for professionals. Speculation means taking higher risk positions in the hope of large gains. It can lead to big profits, but also big losses. Investors also use different types of analysis. Fundamental analysis studies a company's financial health, business model, management, competitive position, and industry. Technical analysis looks at price charts, trading volume, and patterns. Macro analysis studies the broader economy, including interest rates, inflation, economic growth, and global trends. So, strategy is not just about what you buy, it is about how you make decisions, how much risk you take, how long you are willing to wait, and how you behave when the market moves against you. But even with a strategy, stocks can move because of specific company events. That is why investors also need to understand corporate actions. Sometimes a stock moves because the entire market changed, but other times it moves because something important happened inside the company. An IPO or initial public offering happens when a private company sells shares to the public for the first time. This is how a company becomes publicly traded. After a company is already public, it may do a secondary offering. A secondary offering means the company issues additional shares to raise more money. This can provide capital for growth, acquisitions, or debt repayment, but it can also dilute existing shareholders. A buyback, also called a share repurchase, happens when a company buys back its own shares from the market. This can reduce the number of shares available. If the company's value stays the same, fewer shares can mean each remaining share represents a larger ownership piece. A stock split changes the number of shares without changing the total value of the company. In a 2-for-1 stock split, shareholders receive 2 shares for every 1 share they owned, but the price per share is cut in half. A reverse stock split does the opposite. It combines shares to increase the price per share. Stock companies can also grow through acquisitions. An acquisition happens when one company buys another. This can affect the stock prices of both companies. Depending on how investors view the deal, dividend investors need to understand dividend dates. The ex-dividend date is the cutoff date for qualifying for the next dividend. The payment date is when the dividend is actually paid to shareholders. Finally, an insider, someone with access to non-public company information. This could be an executive, director, or board member. Insider actions and trades are closely monitored because they can raise questions about what people inside the company know or believe. So company events can change the number of shares, the ownership structure, investor expectations, and sometimes the stock price itself. Now we have covered stocks, trading, company analysis, stock types, investment tools, market conditions, strategies, and corporate actions. The final piece is risk. Investing is not only about finding winners, it is also about surviving uncertainty. One of the most important risk management ideas is diversification. Diversification means spreading your investments across different stocks, sectors, or asset types. That way, one bad investment does not damage your entire portfolio. Asset allocation takes this idea further. Asset allocation means dividing your money among different asset types, stocks, bonds, cash, or other investments. This mix depends on your goals and risk tolerance. Over time, some investments grow faster than others. This can change the balance of your portfolio. Rebalancing means adjusting your holdings back to your target mix. Investors also use risk and performance metrics. Alpha shows whether an investment outperformed or underperformed its benchmark. Beta measures how sensitive an investment is to overall market movements. A higher beta means the investment may move more sharply than the market. A lower beta means it may move less. The Sharpe ratio measures how much return an investor gets for the risk taken. A higher Sharpe ratio generally means better risk-adjusted returns. Correlation shows how closely 2 investments move together. If 2 investments are highly correlated, they tend to rise and fall together. If they have low correlation, they may behave differently, which can help with diversification. There are also different types of risk. Systematic risk affects the entire market. Recessions, inflation, interest. Rate changes, financial crises, major global events. Unsystematic risk is specific to one company, industry, or sector. Bad management, product failure, lawsuits, problems inside one business. Diversification can reduce unsystematic risk, but it cannot eliminate systematic risk. Then there is the broader economy. Inflation means prices rise over time. When inflation increases, money loses purchasing power. The same amount of money buys less than before. Deflation is the opposite. It means prices fall over time. Falling prices may sound good, but deflation can slow economic activity because people and businesses may delay spending. Stagflation is a rare and difficult situation. Inflation is high, economic growth is weak, and unemployment is elevated. A recession happens when the economy shrinks for a period of time. During recessions, companies may earn less, consumers may spend less, and stock prices often come under pressure. GDP, or gross domestic product, measures the total value of goods and services produced by an economy. Governments and central banks use policy tools to influence the economy. Monetary policy is controlled by central banks, such as the Federal Reserve in the United States. It often involves interest rates and money supply. Interest rates affect borrowing costs, savings returns, business investment, consumer spending, and stock valuations. Fiscal policy is controlled by governments through spending and taxes. When governments increase spending or cut taxes, they may stimulate the economy. When they reduce spending or raise taxes, they may slow the economy. So risk is not just about one bad stock. Risk can come from the company, the sector, the market, interest rates, inflation, recessions, policy decisions, or investor behavior. The better you understand risk, the less likely you are to panic when the market changes. And that is one of the most important lessons for any beginner. At first, stock market terms can feel like a foreign language, but once you connect them together, they become a map. Stocks show ownership. Exchanges make trading possible. Financial metrics help investors judge companies. Stock categories explain different risk profiles. Funds and other assets expand your choices. Market conditions show the environment. Strategies guide your decisions. Corporate actions explain. Company events. And risk management helps you survive uncertainty. You do not need to master everything at once. The goal is not to memorize every word. The goal is to understand where each term fits. Once you have that map, every market headline becomes easier to follow. Every chart becomes less intimidating. Every ratio has more context. And every investing conversation becomes a little clearer. That is the beginner's map to the stock market.